My dear students, welcome back to our channel. In this video, I will be explaining the Bcom third semester subject Principles of Insurance as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 First important short question is: what are actual losses and consequential losses? Give examples. Answer. In insurance, loss means the financial damage or harm suffered by the insured person or business. There are two main types, actual losses and consequential losses. 1. Actual losses. These are the direct losses that happen immediately due to an event. Example: if a fire burns part of a shop and goods worth 2 lakh rupees are destroyed, that is an actual loss because it directly results from the fire. 2. Consequential losses. These are the indirect or secondary losses that occur as a result of the actual loss. Example: after the same fire, if the shop remains closed for a month and the owner loses 50,000 rupees in sales, that is a consequential loss. In short, actual loss is the immediate damage, while consequential loss is the loss of income or benefit caused by that damage. Tip to remember: actual is equal to direct damage, consequential is equal to after damage. Next important short question is: 2. Mention roles of insurance in economic development. Answer. Insurance plays an important role in the growth of a country's economy by providing financial protection and stability. It helps both individuals and businesses manage risks and move forward with confidence. 1. Encourages savings and investment. People regularly pay premiums, which promote a habit of saving. Insurance companies invest this money in industries, roads, and infrastructure projects. 2. Provides financial stability. During accidents, deaths, or disasters, insurance gives compensation. This helps people and businesses recover quickly and continue their work. 3. Promotes business growth. Entrepreneurs take bold steps knowing that insurance will cover unexpected losses, like fire or theft. 4. Generates employment and government revenue. The insurance industry creates jobs and pays taxes, contributing to national income. Example: after a factory fire, insurance money helps rebuild it, keeping workers employed and production running. Tip to remember: insurance supports savings, stability, and strength in the economy. Next important short question is: 3. Define ethical behavior in insurance. Answer. Ethical behavior in insurance means doing what is right, honest, and fair in all activities between the insurer, agent, and customer. It ensures that everyone involved acts with integrity and truthfulness. In simple words, ethical behavior means doing the right thing even when no one is watching. Examples of ethical behavior in insurance include: 1. Honesty. Agents should give correct information about policies, not hide or mislead customers. 2. Fair dealing. Insurance companies must process claims fairly and on time. 3. Transparency. Customers should clearly understand terms, conditions, and exclusions before signing a policy. Example: if a customer's health claim is genuine, the insurer must pay it without unnecessary delay. Ethical behavior builds trust and long-term relationships between the insurer and insured. Tip to remember: be fair, be clear, be honest. That's ethical behavior in insurance. Next important short question is: 4. What are the functions of insurance regulators? Answer. Insurance regulators are government bodies that control and monitor the insurance industry to protect policyholders and maintain fairness. In India, this role is done by the IRDAI, Insurance Regulatory and Development Authority of India. The main functions of insurance regulators are: 1. Protect policyholders. Ensure that customers get fair treatment, genuine information, and timely claim settlements. 2. Regulate insurance companies. Grant licenses, approve new products, and check that insurers follow rules and maintain financial strength. 3. Promote healthy competition. Encourage fair competition among insurers so customers get better services and lower premiums. 4. Develop the insurance market. Spread awareness about insurance in rural and urban areas to increase coverage. Example: IRDAI ensures that no company cheats customers by denying valid claims. Tip to remember: IRDAI is equal to protect, regulate, promote, and develop the insurance industry. Next unit 1. Risk management and insurance terminology. Long questions. First important long question is: explain the concept of risk management. Describe its types and steps involved in the risk management process. Answer. Meaning: risk management means identifying, analyzing, and controlling risks that can cause financial loss or damage to a person or business. In simple words, it is a process of finding out what can go wrong and preparing in advance to reduce its impact. Types of risks. 1. Pure risk. These involve only loss or no loss, no chance of gain. Example: fire, theft, accident, or death. 2. Speculative risk. These involve both gain and loss possibilities. Example: investing in shares or business ventures. 3. Fundamental risk. These affect a large group of people. Example: floods, earthquakes, or war. 4. Particular risk. These affect only individuals or small groups. Example: car accident or theft. Steps in risk management process. 1. Risk identification. Find out what types of risks exist, like fire, theft, illness, or death. 2. Risk analysis and evaluation. Study how often each risk may occur and how serious its effect would be. 3. Risk control. Take preventive measures to reduce risks, for example, installing fire alarms or CCTV cameras. 4. Risk financing. Arrange money to handle the loss. The best method is insurance, where risk is transferred to an insurer. 5. Review and monitoring. Regularly check if the risk management plan is working well or needs changes. Example: a factory owner identifies fire risk, installs sprinklers, risk control, and buys fire insurance, risk transfer. This ensures business stability even if a fire occurs. Conclusion: risk management helps individuals and businesses face uncertainties with confidence. It reduces financial shocks and supports stability and growth. Tip to remember: 5 steps: identify, analyze, control, finance, review. Next important long question is: to explain the difference between the risk of dying early and the risk of living too long. How does insurance help in both cases? Answer: risk of dying early versus risk of living too long. In life, people face two important financial risks related to lifespan: the risk of dying early and the risk of living too long. Both affect financial security but in different ways. 1. Risk of dying early. This risk happens when a person dies before completing financial goals, leaving dependents or family in financial trouble. Impact: family may lose income, struggle to pay for daily expenses, education, or loans. Insurance solution: Term life insurance provides a lump sum payment to dependents in case of untimely death. Example, a 35-year-old father with 2 children buys a 50 lakh rupees term plan. If he dies unexpectedly, his family receives 50 lakh rupees to cover living costs, children's education, and loan repayments. 2. Risk of living too long. This risk occurs when a person lives longer than expected, outliving their savings or retirement funds. Impact: retirement savings may run out, leading to financial insecurity in old age. Insurance solution: annuities or pension plans provide a steady income throughout retirement, ensuring that a person does not run out of money even after 80 or 90 years. Example, a retired teacher invests in a pension plan. Even at 85, she continues receiving monthly income to cover living expenses and medical costs. Key differences: aspect: risk of dying early, risk of living too long. Nature: premature death, outliving savings. Who is affected: family, dependents, individual, retiree. Insurance cover: term life plans, endowments, annuities, pension plans. Financial effect: income loss to family, shortage of funds in old age. Conclusion: insurance protects against both risks. Term plans secure the family, while annuities secure retirement. By understanding these risks, individuals can plan better for family security and financial stability in old age. Tip to remember: early death is equal to protect family, long life is equal to protect yourself. Next important long question is: 3. Discuss the management of risk by individuals and insurers. Answer: management of risk by individuals and insurers. Risk is a part of everyday life. Both individuals and insurance companies take steps to manage and reduce the impact of risks. 1. Risk management by individuals. Individuals face risks like accidents, illness, or property loss. They manage risk using several methods. 1. Risk avoidance. Avoid activities that are too risky. Example, choosing not to drive recklessly to prevent accidents. 2. Risk reduction. Take precautions to minimize the chance or severity of loss. Example, installing fire alarms, burglar alarms, or safety equipment at home. 3. Risk retention. Accept minor risks and bear small losses themselves. Example, paying for small medical expenses from personal savings instead of insurance. 4. Risk transfer. Shift the financial burden to insurers by buying insurance. Example, buying health insurance transfers the risk of high medical bills to the insurance company. 2. Risk management by insurers, insurance companies. Insurance companies manage risk on a large scale and ensure they can pay claims while remaining financially stable. Methods include: 1. Risk pooling, combining risks of many policyholders. Losses of a few are paid from the pooled premiums of all. Example, many people pay fire insurance premiums. If one suffers a fire, the insurer pays from the total pool. 2. Underwriting, assessing the risk of applicants to determine who can be insured and at what premium. Example, health insurance may charge higher premiums to older or high-risk individuals. 3. Reinsurance, transferring a portion of risk to another insurance company to reduce potential loss. Example, if a natural disaster causes massive claims, the primary insurer shares the risk with a reinsurer. 4. Loss prevention and control, advising clients to take preventive measures to reduce claims. Example, insurers may recommend fire extinguishers or security systems to policyholders. Conclusion: both individuals and insurers work together to reduce financial uncertainty. Individuals protect themselves by avoiding, reducing, retaining, or transferring risk, while insurers use pooling, underwriting, reinsurance, and loss control to ensure stability. Tip to remember: individuals manage risk for themselves. Insurers manage risk for everyone. Next important long question is: 4. Explain the process of fixing premiums and the importance of reinsurance in insurance business. Answer: fixing premiums and importance of reinsurance. In insurance, a premium is the amount a policyholder pays to the insurance company in exchange for financial protection. Fixing premiums correctly is very important to ensure the insurer can pay claims and operate profitably. 1. Process of fixing premiums. Premium calculation is based on several factors. 1. Risk assessment. The insurer studies the type of risk, likelihood of loss, and potential claim amount. Example: health insurance premium is higher for older people because the probability of illness is higher. 2. Sum insured. The higher the coverage, the higher the premium. Example: fire insurance for a shop worth 50 lakh rupees will cost more than for a shop worth 10 lakh rupees. 3. Probability and statistics. Insurers use statistical data to estimate the chance of a loss occurring. 4. Expenses. Administrative costs, agent commissions, and other operational expenses are included. 5. Profit margin. Insurers add a reasonable profit while ensuring affordability for customers. Formula simplified. Premium is equal to expected loss plus expenses plus profit. 2. Importance of reinsurance. Reinsurance is when an insurance company transfers part of its risk to another insurer, reinsurer, to reduce exposure. Benefits of reinsurance. 1. Risk sharing. Large losses are shared, preventing financial strain. Example: if a cyclone destroys multiple factories, the primary insurer can claim part of the loss from the reinsurer. 2. Protects solvency, ensures the insurance company can pay all claims even in disasters. 3. Supports business growth, enables insurers to underwrite bigger policies without fear of heavy losses. 4. Stabilize premiums, helps avoid sudden premium increases for customers due to large unexpected claims. Conclusion. Fixing premiums carefully ensures fair pricing and financial stability, while reinsurance protects insurers from large losses and promotes confidence in the insurance system. Together, these processes make the insurance business safe, reliable, and sustainable. Tip to remember. Premiums is equal to fair price for protection. Reinsurance is equal to safety net for insurers. Next important long question is: 5. Discuss the constituents of the insurance market and operations of insurance companies and intermediaries. Answer: constituents of the insurance market and operations of insurance companies and intermediaries. The insurance market is a system where insurers, intermediaries, and customers interact to provide financial protection against risks. It has several key constituents and involves the operations of companies and intermediaries to function smoothly. 1. Constituents of the insurance market. 1. Insurance companies. These are the primary organizations that provide coverage to individuals and businesses. Example: LIC, ICICI Lombard, New India Assurance. 2. Intermediaries. People or agencies who connect customers with insurance companies. Agents represent one company and sell its policies. Brokers work independently and can offer policies from multiple companies. Bancassurance, banks selling insurance products through their branches. 3. Regulators. Authorities like IRDA oversee the market, protect policyholders, and maintain industry stability. 4. Policyholders customers. Individuals or businesses who purchase insurance for protection. 5. Reinsurers. Companies that take on part of the risk from insurers to manage large losses. 2. Operations of insurance companies. Insurance companies perform several key functions. 1. Underwriting, evaluating risks to decide who can be insured and at what premium. 2. Policy issuance, creating and delivering insurance contracts to customers. 3. Claim settlement, processing claims efficiently when a loss occurs. 4. Investments, investing collected premiums in financial markets to earn returns and maintain solvency. 3. Operations of intermediaries. Intermediaries play a vital role in connecting insurers and customers. 1. Selling policies, explaining products, and helping customers choose suitable coverage. 2. Advisory role, guiding clients about risk protection and premium options. 3. Customer service, assisting in claim submission and policy renewal. Example: a person wants health insurance. An agent explains the policy options, collects the premium, and helps submit claims. The insurance company evaluates the risk, issues the policy, invests the premium, and settles claims. The regulator ensures all practices are fair and customers are protected. Conclusion: the insurance market works efficiently because of the coordinated efforts of companies, intermediaries, regulators, and customers. Each constituent has a clear role, ensuring protection, transparency, and trust in the system. Tip to remember: companies provide, intermediaries connect, regulators protect, customers benefit.